Welcome to the Winner's Playbook with Steve and Josh. Disclaimer: the information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you wish to book a free 15-minute call to discuss your personal situation.
All right, welcome back to the Winner's Playbook. My name is Steve Sloan, one of the directors of Link Wealth Group. I'm here with my co-director, Josh Lee. Josh, how are we going?
Good, very good, Steve. It's another week. Pleasure of spending just a little bit of time here with you. Not that we don't spend enough time together, of course.
Awesome.
So I do look forward to these conversations that we're having. But things are well. Everything's ticking along nicely. Lots happening, as we always say, with the business, with the acquisitions coming to the head. Personal life, baby coming along nicely. We bought a pram over the weekend, which was not very exciting. But
they're expensive lessons.
Money's just going out. Yeah, they're not cheap. I was surprised at the cost of a pram.
Yep.
We got a pretty decent pram, but apparently there's levels to the pram game, and it was a cheap one in the broader scheme of things. So all of that's coming along nicely. And some other initiatives worth mentioning as well is we've really started to fire up our Beyond School program as well, which for anyone that's listening, what that actually is a program that we run for high schools, so year 10s, 11s and 12s students. Yep. And we'll basically get out there and we've sort of built a dedicated program and session around it to talk to the students around real life things to help them better prepare for life beyond school and, talk about key things that they actually need to know. Because I know for one, I was a student that went through high school and I was a pest and always told my maths teacher that none of this I was going to apply in my own life. And I was actually correct because none of what I was learning for a lot of high school actually applies in any of what I do as an advisor now or in my day-to-day. So really the motivation there is to help get out and educate the next generation in terms of helping them better prepare for life after high school. So anyone that is listening that would like us to get into their school for that, please do reach out to either Steve or myself or anyone at the Link Wealth Group team for that matter, because we're super keen to get out and spread the message as much as we can with our Beyond School program. But what about on your side, Steve? We were chatting a little bit earlier. You've had some exciting times just helping the kids' canteen with the sports and stuff.
Yeah, that's right. Like you just suggested, it's all about volunteering and getting amongst the community and doing our thing. And that Beyond Schools program, I think, is a really exciting program that we're trying to encourage, amongst the school community to educate the next generation on their finances.
Yeah.
I try to get involved where I can, and I got involved in my son's footy club over the weekend and volunteered to cook the barbecue for the footy club. So
how was the barbecue? How was it?
Passed out. No one got food poisoning, and so I took that as a really, really good result. So
interesting.
We did well. But moving on to today's topic, mate, and it's all about insurance and why you shouldn't just park insurance to the side and ignore it and forget about it. I know this can be a bit of a dry topic, but I think it's a really important topic to discuss and the ins and outs of it. And being advisors, we are well attuned to this topic in particular because we see a lot of it, we do a lot of it. While it's not the key focus for us because we're all about building wealth, but we do need to protect it. Yeah. If we kick it off, mate, and I'll let you run with it from here. What's your take on this particular topic and where can we go from here?
Yep, good intro, Steve, because, insurance is not the fun, flashy stuff that everyone always engages with an advisor for initially, but it's a part of the role of an advisor is a part of it's like risk mitigation and protection, basically. So if I always have the conversations with my clients, if we're setting out these big grand plans for the future, the last thing we want or need is for something to go wrong. And it could be quite minor, it could be quite serious to the extent of someone passing away. But the last thing that we want to do is all of those plans that we put in place, an event happens or something happens in your life and then you throw it all out the window and everything that you've built up, you basically lose it all overnight, which can happen if you don't have the right, risk mitigation and protection there in place. And there's probably a few things to consider there. Like we're more so talking about insurance mostly from that respect. So the common insurances that we do work with as advisors, not general insurance. So it's specifically around life insurance. So if you pass away, total disability insurance, if you're permanently injured or ill and you can never work again. Now that could be from a mental illness for one. I've had that happen to a client before, or it could be you're in a car accident and you're, completely, totally disabled, you can never work again. There's a lot of ways that you could actually satisfy that total disability claim. Income protection, another noteworthy one, covering you if you do suffer an injury or illness, but different to total disability, that it doesn't need to be permanent. It just needs to be temporarily, or if it then goes to permanent, you can still claim your income protection, but you might also be able to claim your total disability at that point in time as well. So income protection, it's actually a lot easier to claim than total disability because you don't need to be off work for a long period of time. And then the last one not so known about is a trauma insurance, and it's not so known about because it's not actually built into your superannuation fund. So those three insurances I just mentioned at the beginning there, they're typically built into your superannuation fund as a default. So you actually get them just when you join the fund, which we'll talk about. Whereas trauma insurance is one you can't take out through your super fund, and it can only be paid outside of superannuation as well. And that one, still very important, but there's generally sort of 40 to 50 conditions that insurers will cover you for there, but it's referred to as critical illness cover as well. But the most common claimed upon events I see is cancer, heart attack, and stroke in Australia. They're the most commonly claimed upon for trauma insurance claims. And the whole idea there is if you suffered, say, a cancer as an example, and I've got a few clients, unfortunately, that have been through this, it doesn't necessarily mean that what happens is going to put you out of action or you're going to pass away. Of course you could, but the idea of the trauma cover there is it kicks in and it covers you to help you get back on track, because if you haven't passed away, well, fortunately you can't claim life cover. If you've maybe had a cancer, I'm using a client I've got, she had breast cancer, quite severe. She wasn't totally disabled, so she couldn't claim her total disability cover. And she actually wasn't off work permanently either. She was actually still able to work in a capacity. So she wasn't actually claiming any income protection. But fortunately, she actually had a large trauma insurance policy of about $500,000. Wasn't one I actually set up. She was from another advisor in the past from another practice before she came to me. But she claimed that cover, and I'll tell you what, it changed her life. And most importantly, helped her recover through the terrible situation that she found herself in. And now she's on the mend and all clear, but geez, it was a big game changer for her in terms of being able to get her through that sort of critical period. And then there's the other part, which we won't touch on in I think this session, because it's probably worth another session, of around, wills and powers of attorney, because that's all a part of that sort of risk mitigation part of it, but we'll sort of keep it to the insurance side of things. But what's been your experience with, insurance and over the years, Steve?
Look, it's obviously a critical part of a plan. I think the key part is just getting the right balance for each individual, because everyone's got their own triggers. One, what's the comfort level? Everyone's got the different comfort level of what they need. How much we need can factor in, how much we want to spend. There's just a lot of variables that go into it, and it's just important to make sure it's aligned to your wants and needs and drivers, because some people want a lot, some people don't need a lot, some people want less and more. But I'd say what's crucial is, if you do put insurance in place, my next question to you is, what are the key mistakes people make when they take out insurance? But I'd say before we go there, I think just the key part of it is those 4 components of insurances that protect you and your family if something goes wrong. It's just important to constantly review it, because as your asset base goes up and life changes, it definitely needs to be flexible and move with the times. So if I go there, mate, and you've obviously been advised for a long time now, you've seen a lot of insurances, you've seen a lot of clients. What are some of the mistakes people make when they go out there and buy insurance?
Yeah. So without an advisor obviously in the mix, it can be a bit of a minefield, I must say. So you generally see those insurers offering like late night, commercials. It's late at night, you flick the TV on and you see these, real life insurance, all these different companies trying to flog insurance on there. Those are normally some of the worst products you need to be careful of, particularly when they're quite easy to acquire. And what I mean by that is, when you get insurance, normally the insurer is going to ask you a hell of a lot of questions about your health, and then they will make a determination if they're willing to give you insurance based upon your health and your risk levels and your occupation and a range of different factors. But there's actually a lot of insurance out there where you can just go and answer a few questions, and then you're insured. The risk there is that stuff is usually cheap and nasty for a reason, because when it comes time to claim, there's a lot greater likelihood you won't actually be, processed and accepted on that claim. So you've got to definitely look out for a lot of those insurance spruikers out there and actually getting insurance done up through a proper legitimate company and going through a legitimate insurance process to begin, where you get medically pre-assessed. You go through all of the application. They might check some records with your doctors so they can get comfort around any injuries or health concerns you've had in the past. and then they will let you know whether or not they're happy to insure you. So you definitely got to watch out for those late night commercials. The other one is also to look out for is just accepting the cover that your fund will give you. And what I was referring to earlier, your super fund, because your super fund can, when you join, unless you opt out, you'll be given a basic level of insurance. And that's usually determined based upon your age generally. So when you join, based upon the age bracket you're in, you'll get a certain amount of cover, and it usually goes up for a period of time. And then you hit a certain age and the amount of cover you actually get starts to decrease. And the actual risk there, or the trap there, is it's not even tailored to your situation whatsoever. So first and foremost, you might be paying for insurance that you don't even need in the first place because your situation doesn't warrant it. Or you might be paying for insurance that you do well and truly need. You've got a ton of debt. You've got some young kids. You actually have a real need for insurance, but the basic cover you've got through your super fund is not even tailored to your situation whatsoever. And then if something was to happen to you, you're greatly underinsured in the event that you're going to try and go claim. And that one I see very, very common because you just get insurance whenever you join the actual super fund as well. So they're two big ones to look out for. And the other thing I would say there is you need to understand the differences between the insurance you actually get through your super fund and taking out insurance through an actual insurer. So the super fund, when they give you cover, you haven't been medically assessed when you join the fund. You just get given a default amount of cover. And then when it comes time to claim, it's going to be a bit more difficult of a process. Whereas if you take out what we call retail insurance through an actual insurer, you've already been medically assessed. The insurer basically knows everything about you. When it comes time to claim, providing you have been honest when you've done your application, of course, it's a much easier claims process. So you kind of pay for what you get in the end there. Like if you want cheap and nasty, there's a market there for you. That's not the stuff that we obviously recommend for any of our clients, because the last thing we want to do is have someone expecting they might get a payout if something goes wrong, and then they've got a cheap and nasty policy. It's got all these exclusions and policies that's changed since they took it out, and then they go to claim and they've got nothing basically. So cheap and nasty is definitely not what you want to be avoiding, but certainly there's no one size fits all, which you were saying before, Stephen. How do you then approach that aspect of it? So how do you go about then determining, and I guess you could look at client situations like someone in their 20s, like, do they need life insurance versus someone in their 40s with a couple of kids, a stack of debt? How do you sort of generally approach, trying to figure out what's the right level of cover to have?
Yeah. So it's all through conversation with the client, right? Many conversations about what their triggers are, what they're comfortable with, what's their risk factors. In a general sense, you obviously want to cover debt and kids, and your own income is a general gist. And then your advisor really needs to work out, okay, what level that needs to be, what will pay the bills, where do we want to save some money or increase in others. It's just that balancing act. But we go through a process. We do a full analysis with debts, incomes, kids, responsibilities, and really work out the numbers with data. I think it's important to just take in the data, review the data, make sure the data is accurate. Here at Link, we go through a fairly in-depth process to get that right. Yeah. And then once we've done that, then it's about assessing, okay, what does this cost look like? Because clearly there's a cost involved, and we need to balance out the risk versus cost, because sometimes the cost is just way too high, right? And there's no point in having lots of insurance if then it really jeopardizes your future as well in terms of financial future. So it's a real balancing act, because you can't spend all your cash on insurance. You've got to build wealth for the future. So your advisor needs to really find that line in the sand of where that level should be, and that's done through conversations with the client and educating the client through what does cover what, and go through a fairly big process there. So it's fairly in-depth, and that's one of my next questions for you, and this is a common misconception out there, and how advisors get paid for insurance advice and why they should be paid for insurance advice, if I can touch on that.
Yeah, so insurance is obviously not stuff that advisors generally like working around, but it's like we said earlier, it's a part of our role, and typically how most advisors will then operate is with that insurance. If the policy is then accepted, the insurer actually pays a commission to the business. Now, there's probably a bit of a misconception around what a commission is. Like, it probably sounds like a dirty word, but ultimately insurance is not typically something that people go out and want to take out themselves. So there has to be some professionals or people out there like insurance brokers or advisors, whatever it may be, who can actually help educate and make known when someone actually needs to take out cover. And for that reason, typically there's two ways you can work with insurance. An advisor can actually receive a commission from your policy. Now, what that basically is the insurer right now that's based upon 60%. So whatever your premium is, if your premium was $1,000 for the year, if your policy was then accepted and you've done it through an advisor, the advisor will get paid, 66%, including GST, but let's just call it 60% because that's basically what they're getting, would be 60% of that being $600. So that's basically how they're paid. But in that situation, they won't charge you a fee for that insurance advice as well. So the insurance advice, the way that we operate is we basically, if it is successful, which is a bit of a risk for us as a business, we get paid a commission on that. Now, you're not paying that as the actual consumer. That's the insurer paying it to us for actually getting them the business, so to speak. But there is some advisors that can also just charge a fixed fee for it. We don't generally just do insurance-only advice. There are advisors out there that might just do insurance-only advice, whereas that's not really an area that we actually look at in itself. Normally, insurance is a small piece of a much larger plan. So our fees, we just charge a fixed fee predominantly for all of the service that we actually provide. But when it comes down to insurance, we use commissions from the insurer to basically cover the cost of our work or time in terms of figuring out the insurance that you need and ultimately going through the whole process of getting there in the end. But it's actually it's a bit of a risk that because there's a lot of situations where you do all this work with insurance and it doesn't get accepted. The insurer declines it. They offer unfavorable terms. And then we as advisors have to actually wear that where we do all this work and sometimes we don't get a dollar from that as well, which is a total risk on our end that we're taking. But there's a process obviously where we can try and help mitigate that by educating clients and doing the right assessments all up front to sort of try and circumvent some of that actually occurring. But to add what you were saying before, Steve, like you said, there's no one size fits all. And sometimes I approach it with, I do some figures up for clients based upon their situation, but then I tell them, look, in the event of something going wrong for you, you want to leave as much money to your family as you possibly can. Yeah. So I'm showing you the baseline of what's going to cover your debts and clear, schooling and all those bits and pieces, all the basics that you want to do. But if you want more cover and you want to pay for that, it's completely your call. It's completely fine. If you want less cover and you don't want to pay for that, that's also completely fine. But let's at least have the conversation so we know that if shit ever does hit the fan, what are you actually going to do? Are you guys prepared to actually sell assets in the event of you passing away? Like if you're trying to build wealth, you're buying properties, investment portfolios, whatever it may be. If you're not going to hold insurance, then just at least know what the contingency plan is. And that might require you then to sell on some assets. And if that's what you're comfortable in doing and you don't want to pay $1,000 or a few $1,000s to hold an insurance policy, that's completely fine. But let's just have that conversation up front so that we know that if inevitably something does go wrong at some point in time, you ultimately are protected because the insurance is not really for you. It's for people around you, basically. So, and one thing I always will say is when someone says to me, look, do I even need insurance? And if they've got a family and kids and everyone's dependent upon them, every now and then I come across someone who's really anti-insurance. And I will say, look, do you have insurance on your house? Do you have insurance on your car? And if you do, which they always do, I say, look, if you're going to start considering what insurance you should be holding, I would probably put your life and your income being protected above that of maybe insuring your car or your contents of your house. That's just my opinion. I'm not saying it's correct, but I would say those things are probably a little bit more important than if you were to run into someone or if something was to happen to the home contents in your home. So it's a bit about prioritizing.
Saying there then, if you got that, you'd probably say, look, why don't you just cancel your contents insurance? Probably maintain your house insurance, so if you fire, you can build your house again. But if you're just covering contents or a 20 grand boat, maybe get rid of that insurance and use it to cover your income.
Quite possibly, because that's the thing. Like I always say to people, your income is the most valuable asset you have. If your income stops, virtually everything can stop in your life. And if you're not willing to protect that, well, you better damn hope you've got some rich family members who can bail you out when things go wrong. And from time to time, I see unique situations where someone is really well off and their family would look after them if something went wrong. That's pretty rare. And I would say, I don't know if anyone would want to rely upon family bailing them out if something was to go wrong. So that's, a way I would think about it. And I would also add to that of the importance there, even from my own personal situation, I talk about it a lot. And I explain clients my situation. Early on, my dad passed away when I was 7. We didn't have insurance. There wasn't a big payout that my mum received. And if, say, my dad did take out insurance very early on and there was enough to pay out a mortgage and set us up for the future, not complaining about my life because I love my life. But hey, life probably could have looked a lot different. When you see someone go through an event or someone's passed away, that's when it's a lot easier conversation to have around insurance, because you can kind of connect the nexus of paying dollars for something that, it's going to protect you. But if you've never kind of seen that in your life, it can be kind of like, it's never going to happen to me. And I'm sure you've seen that before, Steve.
Unfortunately, many times. So it does happen. And it's just that balancing act, right? And that's where good advice kicks into gear and get the right balance between all of that, all the right factors. And, it doesn't have to be the burden of costs and that everyone talks about all the time. You can definitely balance it out. But I'd say the one thing is just always review it, because insurance companies, unfortunately, have a knack of increasing, year on year.
They do.
And if you don't review it, and in 4 years' time, you look back, it would have probably gone up by 40, 50%. So you just need to review it all the time and get some good advice.
If we're talking about cost as well, it's worth noting that you can also pay insurance through your super fund or outside of your superannuation. So sometimes if cost is a concern, but there is a major need to hold the insurance, you could actually consider paying for some of it from your superannuation fund to kind of give your cash flow a bit of a break. Because if you're heavily in debt, you've got a young family, you probably want to hold some level of coverage. And if you can't afford it from your cash flow position, that's where you might consider for a period of time, maybe just pay it from your superannuation. Because again, you've got to weigh up your priorities of, all right, if you're paying it from super, it is going to reduce the growth of your super fund over the longer term. But what's more important to that, or your family being protected if something goes wrong, which it's completely each to their own. But in closing, Steve, drawbacks of insurances besides the cost, the only one I could really think of is sometimes there's a misconception around insurance that you put money into it and you can get some money at the back. Because there used to be, I think in the US, there's still some policies like this where you put money into them and you can actually you're building up some money and you can always take it back out at some point in time. We used to have those policies in Australia. Yeah, exactly right. Whereas all the policies nowadays, they are just a straight insurance policy. So you put money into it, you're paying your premiums every year. There's no pot of gold or anything at the end. So it's really clear to understand that you're just paying insurance for hopefully the fact that you're never going to claim upon it. So it's no different than contents, car insurance, or any of those insurance for that matter. There's no benefit for you for holding it for 30 years other than knowing throughout that whole 30 years you were completely protected. But any other misconceptions or drawbacks?
Yeah, I think the major thing is that people not understanding what they've got. And I think that's a big one. Like there's so many different types of policies, and prime example is sometimes in industry funds we get this unitised cover. Compared to a fixed cover, where unitised cover, as you get older, every year it goes down in cover, and people don't understand that compared to fixed cover. So we never do unitised cover because there's no point, right? You don't know what you want in a couple of years' time, and all of a sudden your insurance cover is reduced. So there's just so many different types, and people have sometimes no idea about what they've got. They think they know what they've got, and they really don't. So that can be a problem for the Australian society, I think. But yeah, apart from cost, wrong levels of cover. I think there's two, every time I have a new client come across my desk, 99 times out of 100, they've got the wrong cover or wrong levels of cover. So that's clearly got to be changed, hopefully over time. But unfortunately, 5 years ago after the Royal Commission, and they reduced what advisors get remunerated on, unfortunately, really people stopped giving advice on insurance. So I think we're sort of walking into an era for the Australian population where we're going to see some significant underinsurance in this country, because not only do we have a lack of advisors giving advice on it, well, people also don't want to give advice on insurance because they can't get paid, and everyone needs to get paid for what they do, right? So we've probably got a bit of an issue right now in Australia. So watch this space. There's probably going to be a few changes in how that all works and feels, but hopefully we can turn it around.
Yeah, we can't sugarcoat it. Like insurance is definitely probably the least favorite part of any advisor's advice that they have to do. There's really nothing fun about it, because you are talking about, grim topics of what happens if, you die or something happens to anyone. But another point I might mention, if you actually have insurance, or you don't know if you have insurance, actually pull out your super fund statement and take a look at that and actually see what levels of cover you might have in there. And if you're going to do one thing as well, Google the term guaranteed renewability, because it's a really important term to understand that the policy you have through your super fund, it's not guaranteed renewable, which basically means, in a nutshell, the insurer can alter the terms of your policy or basically cease to give you cover at any point in time in future and alter the product disclosure statements without you even having a say or knowing what's going on. Whereas if you take out insurance through an actual retail insurer, which is all of the insurers that advisors would then use, that's where you're going to get the benefit of the guaranteed renewable policy. So definitely worth noting what a guaranteed renewable policy is for anyone listening. But guys, we're going to finish it up there. As always, hope you're getting value out of what we are speaking about. And if so, 5 stars on Spotify and Apple. Please do share us around to friends, family, anyone that you may know. If you want to get more of us, we do a newsletter every week that goes out with Steve's email. So please do subscribe to that. And of course, if you want to chat to any of the advisors, Steve, myself, anyone in the team, anyone in our mortgage broking team, or if you need some help with your tax returns, you can always check out our accounting team as well. Feel free to jump on the website and take a look there. But if not, Steve, I'll see you on the next one, mate.
See you next one. Cheers.
Cheers.